Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields back in the range. Call last week, we made a brief stop above 3%, but we're unable to hold it, and it looked like the market was going to try and maybe extend it after we went above it, we danced around it, and then poof, end of the week, we settled below it just slightly. And Monday, today, we continue that trend back as low as 293, 294. So things have really come off here a little bit. In yield speak, we've seen prices rise. Risks really haven't changed all that much. There isn't something that matter-of-factly changed. I think we just failed to get there. And a lot of what's happening around the globe, whether you look at geopolitical risks, the Brexit risks, growth versus inflation risk here in the States, trade fears, which continue to gobble up the media. Those are things that are keeping the Treasury market, I think, from ascending north of 3%, will keep us locked in that range. We're called the old range, 280 to 290, then we extended it to 280 to 3%, and we're now basically nearing the midpoint of that range. So the market not seeing any real bias. Clarity is key here, and right now the market seemingly has none. And if you can believe that, what we're seeing now, despite the fact that we've traded back into the old range, volatility is holding steady, and it's quietly doing so. I think that volatility typically is going to be heading south in these types of markets where we're trading the range, trading expectations. Summer doldrums are here. But market volatility is not elevated, but it's not going down either. And I think that's key here, because when market volatility tends to go sideways for a while, when it should be going down or should be directionally heading in one way and it's not, it means that an adverse trade is probably coming, or a contrarian trade may be coming soon. Right now, that is yet to be seen, but volatility not going down. And as we look at this week, yes, it's all about trade with China. It's all about who's going to have the bigger tariff and who's going to win, and how it's going to affect the multinationals in their equity markets. Likewise, we have a summary of the BOJ's meeting last week when they tweaked policy just a little bit. But then the key here in the States is going to be the inflation data we get, CPI and PPI, on Thursday and Friday. Will those numbers be in line with what the Fed hopes, which is kind of slow and gradual increases to go along with what we're seeing in growth? Fed wants slow gradual increases in both of those if they want to continue to raise rates slow and steady, which is what they have said. Likewise, later next month, we have the big September FOMC meeting, which is going to set the table for the fourth quarter. Likewise, right now we are basically hanging our hats on a 25 basis point rate hike in September and one following in December. But as we look at today, things are very quiet. We're waiting for something to happen that probably we won't get any real momentum until later this week, possibly on Wednesday, but likely on Thursday and Friday we'll start to see our major move. And like I said, with volatility not going down, market smells something out there that we maybe aren't seeing. This is Todd Colvin coming to you from the floor of the CME Group.